Hey investors, thank you so much for joining us. Today we're going to talk about something slightly offbeat. We're going to talk about TheWorks. So my name is Michael from Deep Value Returns on Seeking Alpha, and I run a premium newsletter that talks about value stocks and growth stocks. Manuel, do you want to talk a little bit about you and what you do?
I run allinstocks.com. You can find all of my work over there. And today, to honor Michael's service or subscription name, Deep Value Returns, I'm bringing you a deep value opportunity from the UK, right? You're from the UK, Michael, and you've been to TheWorks shops or stores to help me out with my research. And I want to be talking about that in a minute. First of all, I don't know if you want to start by saying something. If not, I'll just go into it.
Please do go into it.
Okay, so TheWorks. First of all, I've got to thank Clark Street Value for helping me understand this company. TheWorks is a specialist discount retailer from the UK, and it's similar to Five Below in the US, and we'll get there in a second. And Five Below says, the management says that they sell things that nobody wants, and TheWorks is similar to that. So they sell fidgets, balloons, puzzles, board games, books. Of course, some of these things people do want, but a lot of them are just like toys or usually low valued items. And their biggest there's big seasonality, and their biggest season is of course Christmas time. So we're expecting.
Before you come into that, just set this up here. So, I mean, I look at the share price, and the share price in the past year has done quite well. Come out of that bump. Is this just because it was so cheap, or is it possible that the market in the UK has kind of come back a little bit? How do you feel about that in the past year? How has this kind of moved up?
Mostly because it was cheap, right? It's still cheap from my point of view. It's like 3 times free cash flow, which is absurdly cheap. It's really deep value. Mostly because of that. The stock or the company IPO'd in 2018, if memory serves me. The initial plan was to grow stores up to 1,000. They now have 520 something. And at some point, a couple of years ago, new management came in and decided that the way to go wasn't so much to grow the number of stores like crazy, like they were doing, but to actually improve the profitability of each store, improve unit economics. And usually when I hear good unit economics together with retail, my ears just tune in, because usually when you have good unit economics, the next step is to grow the footprint, the number of stores, but you shouldn't grow if you don't have good returns on your capital. So when they decided to stop that previous plan and to get better better unit economics, I listened, and I've also listened to the share price, which is, or the valuation, which is for me just crazy. Just like Five Below. And now, how do they improve that ROIC and unit economics? It's pretty simple. They're trying to go to direct sourcing their inventory from Asia. Mostly it comes from Asia, just like Five Below. They've been doing it through wholesalers, which isn't that good. They got to pay the commissions. They're also making a lot of steps, taking a lot of steps in operational efficiency at the stores, improving the store layout, the online store as well. And I would say that you, coming from the UK, would tell me or would ask me if retail, and you've asked me at the beginning, if retail isn't dying, and it is. These guys are seeing lower footfall. They've been having seeing like-for-like growth ever since 2016, but that has been mostly derived from the higher basket value rather than the number of transactions or the number of clients. Having said that, these guys have some, the demise of retail can be seen in a good way for these guys because their average lease term is 2 years. So they've been every year, they have several stores that are there whose leases are reaching the end. So they've been able to renegotiate lease terms with the landlords, renegotiate them down, of course, the lease expense is going down. And not only that, but they have also been able to get the landlords to pay for the initial capex to build out the stores. So in the most recent trading update, they've mentioned,
Before,
and I wanted
just before you come on to that, so just let's step back a tiny bit here, just a tiny bit. So if I look back to how the company reported before the pandemic, it's kind of growing, let's say, kind of around single digits, like 5-6% year over year. Then the pandemic hits, like a lot of retailers, they were down 20% year over year. You know, stores closed down, etc. People couldn't trade, so you know, stores are down, revenue is down 20% year over year, and then all of a sudden they come back up as you would expect, right? So back in the summer of because their fiscal year is misaligned, right? So their fiscal year and the calendar year gets very confusing. If you look back how it traded last summer, they were up 30% year over year. So a portion of that would just be because they've reopened the stores. So you get in that bump up. So at the surface levels, you're like, that's not that exciting, right? You lost 20%, next year you gain 30%. So you kind of up a little bit, but it's kind of like, that's how it is, right? Not that exciting. And just before, and you know, a lot of retailers have done that. If I look at, let's say, some of the stocks that I've owned in the past, like Bed Bath & Beyond and like countless others, the market has seen that it's not that exciting. But then please tell me what happened on Friday.
Well, on Friday, they've issued a trading update saying that the EBITDA, they're guiding for EBITDA of 15 million for the whole year, which we'll know in six months time or several months ahead. And 15 million EBITDA will translate roughly into 9.5 million free cash flow. The current market cap is 40 million. And if you take out the cash, which will be 10 million, it's trading at 3.3 times free cash flow. So that's what happened on Friday. That's hence the share price appreciation. And what are you saying?
So a few things that I kind of saw. So I looked through this, and as I said, you know, I looked through this. You kind of send this, and I kind of look through it. And the first thing that I kind of looked was that the guidance that they put out was that they're trading ahead of expectations. So compared to the same period a year ago when the shops were kind of open in the December period, which is there when they really make their money. You know, the rest of the time is just like exists.
Yeah.
So
they lose money the rest of the time.
Yeah. And when they actually make their money is this H2 period, this second half of the year, which is right now. And they said that they're performing ahead of expectations. So right away, that's kind of interesting. Then they talk about that they're going to spend 3.5 million in capex. So if you look at, let's say, they say that they're going to make approximately 15 million of EBITDA, and you subtracted 3.5 million of capex, you're kind of around 11.5 million of free cash flow. Even if you round to 11, it's 11 million of free cash flow. And you look at, let's say, for example, so you've got a business that is surprisingly profitable. You got a business that just described when they move to a new store, because commercial leases are coming down in price, you're able to move that. You get some funding from the landlord to kind of help you out a little bit, and you're able to, you know, they kind of help you fund that store, that capex. So I look back and I saw that in 2019, the capex was approximately, I think it was, let me just get this number up. Just 1 minute, please. So the capex in like their fiscal 2020, so it's kind of like that's kind of misaligned slightly. The capex was 9 million, and then obviously COVID hit, and it was down to 2.4 million. But now, as you said, they kind of not looking to buy more stores. Really, they may renegotiate some leases and go into cheaper properties, but they're saying that the capex is going to be 3.5, so towards the lower end of what the capex is going to be for the business. And the problem with retail very often is this is quite capital intensive because you're having to hire the store. So compared to what it was 2 years ago, the capex is lower. They just reported record Christmas sales. They just announced that they're going to make 15 million of EBITDA. They're saying that their capex is going to be approximately 3.5. So even if you kind of think about this, makes 11 million of free cash flow, and you have a balance sheet where last year they paid back all their debt. So debt-free, it trades for approximately 4 times or so free cash flow. And then they say, I look back to what they said in the summer, they're like, oh, you know, if we'll see how things go in the future, maybe after Christmas 22, we will consider in January 23, maybe perhaps if things work out well, to give a dividend. But then I look at the announcement on Friday and they're like, actually, no, you know, things are going quite well. And we're actually going to reconsider reinstating a dividend. So you get a business that doesn't have a lot of avenues to kind of redeploy cash flow, makes already a lot of free cash flow, has net debt on its net cash on its balance sheet, and they're going to reinstate a dividend. I mean, I don't know what the dividend is going to work out at. I have no idea. But, you know, this could be interesting, right?
Exactly. There's a lot of stuff. First of all, you've said it perfectly. The nice summary of the situation, of the valuation. I would say that they're seeing some increased freight costs. So the free cash flow could even be higher if it wasn't for that. I would also not, I don't actually like to see them considering dividends. I would love to see buybacks, but that's their thing.
It's a very interesting discussion because a lot of people kind of have the idea that they prefer them to invest in a business. There are other people that want buybacks. There are people that want a dividend. I used to very much be towards the buyback camp, you know, the Buffett buyback camp. But after reading a bit of from Constellation Software, as a company we haven't really talked about before, but Mark Leonard, he said in the past that it's actually much more worthwhile to have a dividend come out every so often, even if it's kind of a one-off thing, because it doesn't force you as the shareholder to, is now a good time to sell? Is now a good time to buy? Because the buyback is kind of forcing you to, I have to act, I have to do something. Whereas if you just get a dividend every so often, it kind of changes that equation that you're more inclined to become a long-term shareholder. Now, I don't want to be a long-term shareholder here, but it's just a different side of the equation that if you're going to get the dividend, it's kind of a different type of shareholder base. It's kind of that it's not kind of looking to get in and out. It just aligns you better. It also smooths out a little bit of the volatility as well, the share prices, I suppose.
That is, and we could talk about that in depth in another time. That is a great subject. What I could say about that, taking the opposite side of the argument, would be that for a company that doesn't need to financing, right? So it doesn't have any debt and it's cash flow generative. Why would it want to have, or why would it care if it has shareholders who prefer dividends to buybacks, right? I'm not sure if I explain correctly my point of view, but why would they want to have shareholders who prefer the steady dividends when they could deliver much more value with stock buybacks right now at this price, at least?
Well, yeah, I mean, it's from a governance perspective, you know, the board, what they want is really a steady share price. And if the share price is steady and it's not very volatile, people will pay a premium for that kind of quote unquote safety because it looks safe, right? If the share price is very steady, if you think of, for example, if you look at something like a biotech company, it's up and down, up and down, up and down. Yeah. People don't pay a premium for that. Whereas if you look at something, for example, like Amazon, it's kind of like a steady line. There's like no, the shareholder is very long-term oriented. But anyway, okay, this is a bit of a distraction. What I did like about this is when I looked at it, the chairman of the board owns approximately 16% of the company. Now, out of all the management, this guy, I can't remember, Hoyle or something like that. What's his name? Let me see. Dean Hoyle. So Dean Hoyle owns approximately 16% of the company. Now, the CEO himself doesn't own very much, like just a few kind of shares, really nothing very significant. But Dean Hoyle, owns a significant amount. And if I look compared to the previous year, he hasn't sold any shares either. So when the share price was substantially higher, he didn't sell. And when the share price is lower, he still didn't sell. So he seems to be quite interested, in my opinion. Maybe I'm kind of skewing things here, but he seems to be quite interested because, in seeing the share price go higher over time, because the person owns, close to, let's say, 5 million worth of stock in a tiny little nano cap company, and they have seen their ownership go all the way down. I believe that they would be quite motivated to put the right people in motion to kind of see the share price come back up a little bit. Would you say that's possible?
Yep, the management is at least from I haven't heard any conference call from them, but at least from what I've been reading on the filings, they're doing the right things. So improving margins, improving operational efficiency, improving return on capital, all of that prior to thinking of growing. So I like to hear that. If they're going to be successful, that's yet to be seen. And let me remind you and the people who are listening to us and watching that there's also a lot of stuff not to like here, right? It's not a 3 or 4 times free cash flow stock because it's amazing, right? This is retail. This is low margin retail in the UK. There's a lot that can go wrong. And if you ask me, would you want, and you've mentioned this briefly, would I want to own this stock for 30 years? Not right now. I'm not saying that because if we look at Five Below in the US, which is similar, a little bit different, it's trading at 34 times earnings. So they have great unit economics and they're expanding, growing because they already have that high ROIC and those great unit economics. So there's a slight chance that TheWorks can work, right, in the same way or similar to Five Below. I'm not actually investing because of that opportunity. I'm investing because 3.3 times free cash flow is rather cheap, and that's it. If they get to 1,000 stores, double the store count with great unit economics, so much the better. I'm not sure if I'll still be around by then, but for now, for the current opportunity, it's a cheap stock.
I mean, so one of the investment risks that you already highlighted is that this is kind of a small cap name, right? Sentiment is here today, gone tomorrow. People can move in and out. And then as we've seen in like tech names, when things start to come down, it comes down really quickly, particularly in this like underfollowed nano cap space, just a bunch of traders and algorithms kind of trying to beat you out. So that's one kind of investment risk. The other one that you mentioned, which is obviously very pertinent, the high freight costs are weighing down the business's ability to have attractive margins. You already mentioned this already, that we're hoping that the business's freight costs don't get significantly worse. If they stabilize, that would be great. We don't need them to come down, but if they stabilize. But there's also, of course, wage increases as well. So there are kind of a lot of things that it's not that it's an easy layup. There are things that can go wrong here. Interest rates don't have a particular effect here, but when it comes to you're having to pay higher wages and you're getting freight costs
that's one
higher,
of the
which
biggest.
is your biggest cost. Your biggest cost as a retailer is really the people that are working in the store ultimately. So, and obviously the merchandise. And if the merchandise goes up and the wages go up, it doesn't leave you a lot of room for kind of maneuverability. That being said, it does look quite, it does look that they make a significant amount of free cash flow. So I think that that's kind of fair enough. We'll have to see how things develop from here. I mean, in the interest of full disclosure, I kind of you sent me this. I looked for this in the morning, and I decided to pick up a few shares. So I don't know how this is going to work out, but I just wanted to kind of, we normally kind of run this as a kind of a bull and a bear case, but when I went through this, I felt that the odds are kind of favorable. It's not, but you're not paying, let's say, 3 times forward sales. You're paying 3 or 4 times free cash flow from that's already been passed. They've already made it, and they're still kind of growing. Even if they only grow at, let's say, 2% on the top line, it's like, that's really kind of.
They're getting for 10 to 10 stars tops. So 10
again,
out of what? I'm sorry.
What did you say? Say again.
They're getting for 10 new stores maximum each year, at least in the next few years. So
yeah, I think so. If it looks reasonable, essentially, it looks quite attractive. Fingers crossed.
Let's see. Yeah,
let's
see how we go. No, that's it for now.
Okay, thanks for listening, everyone. Thank you. See you soon. Bye.